Hi guys, how you all? I hope you're all doing good. So welcome back to part 3 or lecture 3 of our CA Intermediate Advanced Accounting May 2022 suggested answers discussion. In the first part, we solved question number 1 and 2. The second part, we solved the question number 3 and 4. And this is the last part wherein we will be discussing the solutions to question number 5 and 6. Before we get started, the announcement is with regard to the November 2022 aspirants. You have an amazing batch starting called Excel with Yash's batch. This is for Group 2, all the subjects of Group 2, 100% comprehensive learning in English. This is happening on the Unacademy platform from the team of Yash's Academy. You get to learn economics from Shanda Rama sir, financial management from Dhananjay Bhave sir, Karthik Iyer sir will be teaching you audit, Burgesh Madlani sir will teach you EAS, Ravikant sir will take up accounting standards, Meeta Mangal ma'am will take strategic management, I and Mayur Nahata sir will handle your advanced accounting part. Yeah, the schedule for the batch till the end of August is here. For the month of September and the early part of October will be updated to you people a little later. You can take up Unacademy Iconic subscription, the flagship model of Unacademy, to join us in this journey. So Unacademy Iconic subscription comes with few added more benefits than just a normal plus subscription of live interactive classes, recorded backup, unlimited viewing, and one subscription giving access to all the educators' notes and learning. Other than this, you get additional benefits like one-to-one live mentorship, hard copy of the materials coming to your doorstep, sessions from industrial experts, and lot more. So, Iconic subscription will come at a cost of 62,000 for 24 months, 38,250 for 12 months, and 30,000 for 6 months. And you can use the code YESHES to avail 10% off on the prices that we just saw now on the screen. Yep. And that's the news, and let's now get back to our May 2022 examination question paper, question number 5. Great. So we previously discussed 1, 2, 3, 4. Now fifth one. In the analysis sheet of our Excel, which I'm going to pin it for you people in the description to this video, we would have done the analysis. Yeah, I'll show you the analysis sheet. Yep. So the analysis sheet says that question number 5 has two subparts. First subpart is about buyback. Second subpart is on computation of capital adequacy ratio of banking companies. Then we have question number 6, which has A, B, C, D, 5 parts. It's a 25 marker. Two questions are from accounting standards. Accounting standards 17, one question, and accounting standards 19, one question. One is on differential rights, and one is from liquidation 5 marks, and the last part is from employee stock option plan. Chalo. So let's start with the buyback question. So this is on a question wherein the answer is expected about maximum permissible buyback. An interesting one. A similar question had come in the last attempt or last attempt also. So I think the last attempt. Last attempt also had a very similar question. Yes, it is the last attempt. I remember seeing the answer scripts of a couple of students. And majority of them usually get this wrong. I'll tell you where do you get this wrong. If you look at this kind of a question, wherein you are supposed to tell what is the maximum permissible buyback, in the ICI material for this question there is simultaneous linear equation that they use, especially for the debt equity ratio condition. They take, let this be x, let this be y, x is so much of y, they take an equation and then solve. In formulating that equation, people get it wrong. Simplification of the equation and finding the values is easier, that everyone does it good. But when you're formulating that equation using x and y, that's when people mess up, because that CRR part or premium part, so there they get it wrong. So to counter this, I've given a very simple equation what people can follow. I've covered the same thing in the marathon revision also. You can go back to see marathon revision. It's on the same YouTube channel. If you search for it, you'll get marathon revision for CA intermediate. There in the buyback chapter also, I've given that simple equation what you can follow, which will help you crack this. You get this? So that's a small reference. I'm not gonna tell throughout the video like this we've done in class, this we've done in marathon revision, this I told it will come. No, this video is not going to be that way. I'm just going to discuss solutions to the paper, and definitely everything was referred to in the regular class. Chalo. As well as in our marathon revision. Yep. I hope it was helpful if you had seen it. Quick Limited has the following capital structure. Fantastic. As on 31st of March 2021. Share capital is given, resource and surplus given, lot of things given. On the recommendation of the board of directors on 16th September 2021, shareholders of the company have approved a proposal to buy back the equity shares. Fantastic. The prevailing market price of the share is 20. And in order to induce the see, if you give the same price what is there in the market, people would sell it in the market. Why would they come and accept your buyback offer? So if you are offering buyback of shares, then you would have to quote a price that is slightly higher than the market price to ensure that there is a, let us say, successful buyback. Yeah. So it was decided to offer a price 50% over market value. So 20 rupees per share is the existing market price. And in the buyback offer, they're offering 50% more. 50% of 20 is 10. So if they're offering 10 rupees more than 20, then the offered buyback price is 30 rupees. I hope you all agree and then accept with the fact that offered buyback price is 30 rupees. Fantastic. The company had sufficient balance in its bank account for the buyback of shares. So there is sufficient money, so don't worry about the money. You are required to compute the maximum number of shares that can be bought back. So basically you need to see DRS. Dhoni review system? No, not Dhoni review system, but it is debt equity ratio test, resource test and share outstanding test. All these three tests have to be addressed by. Okay. Under the situation, loan funds of the company are either 1680 or 2100 crores. See, in the balance sheet, we'll arrive at certain amount of loan. It's here. Other than this, they have given two more scenarios. If instead of the loan given in the balance sheet, if the loan is 1680, then what? Or if the loan is 2100, then what? So these are two alternative conditions given which we need to check for. Okay, assuming that the buyback will be completed by 31st of December, pass necessary journal entries, narration is not required. Fantastic. Chalo, I will however give narration. Let us start. So there are three tests to be seen. Number one, debt equity ratio test. Number two is resource test. Number three is share outstanding test. So debt equity ratio test says that amount of buyback whenever it is done, after shares being bought back after the buyback, debt that is outstanding and equity that's remaining after buyback. If we compare or if we find the ratio should not be lesser than 2:1. Yeah, equity should be at least half of the debt. It cannot be lesser than half. That's the debt equity ratio test. Resource test says that amount used for the purpose of buyback, maximum permissible amount that can be used for the buyback, should be max to max 25% of the paid up capital plus resource plus security premium. You get this? And the last one, share outstanding test, it says that maximum permissible buyback is limited to 25% of the shares outstanding in the company. Yeah. Let's start with the first one. But before we start, we'll compute these two items, which will become very handy for us in the rest of the problem. First one is equity. Equity is referred to in the first two conditions. One is debt equity ratio test. Second one is resources used, D as well as R. So what is equity? Equity is share capital plus reserves plus security premium. Yeah, all the free reserves are also included. Now equity share capital in this question is 462. So let's pick 462 here. And then reserves. Reserves will take general reserve, P&L account and security premium. See? General reserve is taken, security premium is taken, P&L account is taken. So this capital redemption reserve, statutory reserve, plant revaluation reserve, all these are not taken. So only 336, 126, 126. So 336, 126, 126. That gives us equity of 1050. Debt, as I mentioned, it is 2520. I previously only suggested, in case 1. And they want us to compute in two alternate scenarios wherein the debt is 1680 and 2100. So let me write that 1680 and 2100 are two other alternative scenarios. I hope you all agree. The equation that I was talking about some time ago is, so don't do that debt by equity is equal to 2 by 1 and then debt is equal to 2 times equity and then equity may you write something, CRR will come, buyback is there, buyback is X, CRR is Y. No simultaneous linear equation. Simple terms. Use this formula. The maximum permissible buyback to ensure that the debt equity ratio is 2:1 is paid up capital plus free reserves plus security premium minus 50% of the debt divided by buyback price of the share plus the nominal value. Sir, but doesn't buyback price include nominal value? Yes. Why do we add nominal value all again? CRR. CRR should be created, no? So much funds will be required. I'll repeat. Just take equity, that is paid up capital plus free reserves plus security premium minus 50% of the debt divided by buyback price plus nominal value. This is a simple equation. You apply this, khatam, guys. Rest everything done. We've already computed 1050 as our equity. So I'll take 1050 minus case 1 mein debt is 2250. So 50% of 2250. That divided by 30 plus 10. If I do that, I'll get minus 5.25. So maximum permissible buyback is 5.25 minus, meaning already the debt equity ratio is bad. The present debt equity ratio itself is bad. You can't go for any further buyback of the shares. Next scenario, 1050 equity will remain same. 50% of 1680, case 2, divided by 40, 5.25. Yes. So maximum permissible buyback is 5.25 crore shares, because denominator mein, when we took buyback price and nominal value, we took per share. So the answer that we get here is number of shares that can be bought back only. Got it? 5.25 crore shares can be bought back under scenario number 2. And scenario number 3 will take debt as 2100. In that case, if I see, I'll do 1050 minus 50% of 2100 divided by 30 plus 10. 30 is buyback price, 10 is nominal value. When I do, I'll get 0 exactly. So meaning buyback is not possible. Only in scenario 2, when the debt is 1680, buyback is possible. In other cases, buyback is not possible. Got it? So let's go to resource test. Resource test talks about how much money will be used for buyback. So here, when we say amount of money used, it doesn't just come to arrive at nominal value of the money paid. No. It is buyback price. Nominal value plus premium. Yeah. So what do we do? Maximum permissible buyback is limit is 25%. No? 25% of equity. So 25% of paid up capital plus free reserves plus security premium. That is the total money that can be used. I'll divide this by buyback price per share, so that the answer that I get is maximum number of shares that can be bought back. So I'll take 25% of 1050. 1050 is equity that I computed before even starting with conditions. Divided by buyback price is 30 rupees. 20 rupees nominal, 20 rupees market price, and plus 50%. No? So 20 plus 50% is 30. So 8.75 crores is allowed for you to be bought back. But condition number 1 will allow us maximum to buy back how much only? 5.25 crore shares. Which one do we go by? We need to comply with both the conditions. So condition number 1 will take over. Yeah, however, let's see the condition number 3 also. Condition number 3 is share outstanding test, which says maximum permissible buyback is 25% of shares outstanding. So it is 25% of number of shares. How many shares are outstanding? Let's quickly see that. In the question they have given 462 crores. Shares are of rupees 10 each. So 462 crores divided by 10 is 46.2. So 46.2 crore shares by 25%. That comes to 11.55 crore shares can be bought back. So we had 3 situations, debt 3 scenarios. In the first scenario, no buyback possible. In the third scenario, no buyback possible based on first condition. Only in the second condition, second situation, 5.25 crores is possible. And resource test says 8.75 crore and share outstanding test says 11.5 crore. Complying all the conditions, the maximum permissible buyback is only in the second scenario, wherein the debt is 1680 crores. The answer is about 5.25 crores. If you buy back 5.25 crores, the entry will be first. You need to write the entry equity share buyback account debit to bank account. You need to pay the money. This is for 5.25 crores into 30 rupees. And then these shares, whatever are bought back, will be cancelled. So that here, whatever equity share buyback is debited, no, that will be credited, and the debit will be given to share capital account to the extent of nominal value. Beyond that, whatever you paid will be premium on buyback, which will be later adjusted against our security premium. So the entry will be equity share capital account debit, premium on buyback account debit to equity share equity shares bought back account. So 5.25 crore shares into 10 rupees nominal value into 20 rupees premium, both will be debited. Credit will be given to shares bought back, because that 30 rupees, whatever you have debited here, that account needs to get closed. Next, 2 things you have to do. Number 1, you need to close this premium on buyback by adjusting it against security premium. Number 2, you need to create CRR, capital redemption reserve, to the extent of nominal value of shares bought back other than by way of fresh issue, because the capital is reducing to comply with Companies Act. Yeah, let's write this off. Premium on buyback is written off by crediting premium on buyback and debiting security premium. Next is creating CRR, general reserve or P&L account can be used, and the credit will be given to capital redemption reserve. This is done to the extent of nominal value of shares bought back only, not to the extent of security premium. Not. So 5.25 crore shares are bought back, multiplied by 10 rupees per share, that gives you 52.5. Fantastic. That's the solution to question number 5A. Let's now go to question 5B. What is 5B? This is with regard to banking companies. Deluxe Commercial Bank has the following capital funds and assets. This is a question on computation of capital adequacy ratio. Yeah. So you are required to segregate capital funds into tier 1 capital and tier 2 capital. Fantastic. Find out risk adjusted and risk weight assets ratio. Okay. They want us to identify risk adjusted assets and risk weighted assets ratio. So let's do that. So tier 1 capital and tier 2 capital. You must be aware, we've discussed this in banking company. Tier 1 capital means there will be paid up capital, free reserves, all disclosed reserves will come and statutory reserve will come. However, capital reserve will not come to the extent it is revaluation reserve. If there is revaluation reserve, it will be taken after discounting 55% in tier 2 capital, but not in tier 1 capital. So here we have paid up capital 2400. This will be tier 1, statutory reserve 480 tier 1, security premium 480 tier 1, 288 में we eliminate 128 and balance will be taken as tier 1 and we deduct this 48 from tier 1 capital. So I have taken 2400, 480, 480, 228 after deducting 128 revaluation reserve and then 48 intangible, P&L account debit balance. Oh, there is intangible asset also. Okay, there is intangible assets of 48 that will also be considered. That will also be deducted. Got it? That is tier 1 capital. This 128 here, I'll take it here after deducting 55% discounting. I'll consider it as tier 2 capital. So tier 1, tier 2 total capital is 3424 plus 57.56. 57.6 will give the tier 1, tier 2 capital. And there are certain assets. We know the rates on RBI or central government it is 0%. If it is other banks 20%. Any other investments is 100. Real estate is 150. So you know all those percentages. So we will apply those percentages on these assets. Whatever we have here. See. This 192, I'll write that 182 and then charge 0% because it's with RBI. And there is claims on bank 544 on that 20%. Yeah. On that next we have other investments 7360, 100%. Yeah. Then guaranteed by government of India 1280, 0%. You get this? Then if it is covered by what to say superannuation fund, full security is there. So there is no risk. Again 0%. See 160, 0%. Done. Then we have other loans and advances 100%. Premises, furnitures and fixtures 100%. So we multiply 100%, 100%. So we will have off balance sheet items given here. Acceptances endorsement 4800 and 160. So they also will take 100%. Once we take that, if we multiply, we will get risk weighted assets 4960. Then simple. Take tier 1 plus tier 2 capital in the numerator. Risk weighted assets in the denominator. Multiplied by 100. What will you get? Capital adequacy ratio. Have a look. Risk weighted assets ratio or also called as capital assets ratio is capital adequacy ratio is tier 1 plus tier 2 capital divided by risk weighted assets plus off balance sheet items multiplied by 100. If you do which, you will get the answer as 13.64. And this, my friends, is the answer to question number 5. I hope you all understood. Chalo, let's go. We'll go to question number 6 now. Question number 6, what is it about? Oh, this is on segment reporting. 6 mein, you have actually 5 sub questions of 5 marks each. Basically, it's 25 marks, but you are supposed to get only 4 in the exam. However, I will discuss answer to all the 5. Yeah, first one, A. XYZ has 5 business segments. Very good. Profit and loss of each segment for the year ended 31st March 2022 has been provided below. You are required to identify the following whether reportable segments or non-reportable. What do we do? See, reportable or non-reportable basically is dependent upon management discretion, based on the assets, based on the revenue, based on the result, or that is profit or turnover. I usually call it MART, M-A-R-T, M, management discretion. A, asset, R, result, T, turnover. Management discretion, whenever they, whichever organization they want to be, sorry, whichever segment they want to disclose as a reportable segment. Asset, result, and then turnover. If the result from that segment or asset from that segment or turnover contribution from that segment exceeds 10% of the total revenue, total result or total turnover or total assets. Yeah. In this case, they have given profits and there are certain cases losses also. So what we need to do? Segregate the profits and losses separately, write profits separately, write losses separately. Take the total of profits and total of losses. Take 10% of profit and 10% of loss. Pick whichever is smaller or whichever is the lesser amount. And in any period of time, if the result from that particular segment exceeds the 10%, then that is a reportable segment. If not, not a reportable segment. At a later stage, cumulatively, if the reportable segment say revenue is less than 75%, then management by discretion can pick another reportable segment. That and all is possible. But present question that's not tested here. So let's write this A, B, C, D, E, and then C and D 175 and 105 negative. 175, 20 and 105. Okay. A and B are 25 and 20, 225 and 25 profit. So we'll do the total of profits, we get 20, 250. Total of losses, we get 300. Whichever is higher, oh sorry, I was telling whichever is lesser throughout. Sorry, I got carried away. Whichever is higher is what we take. That comes to 300. 300 by 10% is 30. So any case, if it is greater than 30, reportable segment. Or if it is not greater than 30, not a reportable segment. 225 is greater than 30, reportable segment. 25 is lesser than 30, not a reportable segment. 175 is greater than 30, reportable segment. 20 is lesser than 30, not a reportable segment. 105 is greater than 30, is reportable segment. So basically, segment B and segment D are not reportable. Segment A, C and E are reportable segments to be reported separately. Got it? And a little bit of theory what I told previously. A17 segment is considered reportable based on assets, revenue, profit and management discretion. Revenue in this case is turnover. Yeah. Okay guys. So that's with regard to 6A. Shall we go to 6B? 6B looks like having some sub questions. Let's see the first one. In a limited company, equity share capital is held by this is differential rate. This is very easy part. This is very easy part, and you every attempt like they ask 5 marks from this question. So this again like lottery. In a limited company, equity share capital is held by X, Y, and Z in the proportion of 30 is to 30 is to 40. Also, A, B, and C hold preference share capitals in the proportion of 50 is to 30 is to 20. Yeah, now we need to find the combined ratio. You get that? The company has not paid the dividend to holders of preference share capital for more than 3 years. Given that paid up share capital of the company is 1 crore and because their preference share dividend is not paid, they also will have voting rights now. Yeah, they will ask us to compute the voting rights. Preference share capital is 50 lakh. Find out the relative weight in the voting right of equity shares and preference shareholders. Yeah, chalo, let's do this. So what do? We have XYZ equity shareholders and their capital is 1 crore. Have a look. 30, 30, 40, 1 crore XYZ will split, and then between ABC or preference shareholders in 50, 30, 20 ratio will split 50 lakh. Hello, see this 6B shareholder XYZ 1 crore 30, 30, 40 ratio equity share capital. See 30, 30, 40. And then ABC preference share capital 50, 30, 20 ratio 50, 30, 20. Yeah, if I split this, I'll get 30, 30, 40, 25, 15, 10. So I'll add both. I'll get 1 crore 50 lakhs, 1 crore 50 lakhs here. Write the same amounts here 30, 30, 40, 30, 30, 40. 25, 15, 10, 25, 15, 10. Now on the whole, I'll start finding the percentage. 30 divided by 1 crore 50 lakh. And then 30 divided by 1 crore 50, 40 by 150, 25 by 150, 15 by 150, and 10 by 150. And this 3 is to 3 is to 4 is to 2.5 is to 15, 1.5 is to 10 or 1. Or I can say 30 is to 30 is to 40 is to 25 is to 15 is to 10. Is that new proportionate voting rights that each of the shareholders XYZ and ABC have respectively. Very easy, no? Like I mentioned, yes, absolutely easy one. Done. So then there is a second sub question to this. Also, company proposing to issue equity shares with differential voting rights. To the extent of 50 lakhs. Assuming that the company fulfills other conditions pertaining to issue of shares. Can the company issue the shares with differential voting rights? The answer is no in this case. Why? They have mentioned here, no, in the beginning part, company has not paid dividend to preference shareholders. Whenever the company has not paid dividend to preference shareholders, then it cannot go for issue of any further shares with differential voting rights. Yeah, differential voting rights is shares with more than one vote or shares with less than one vote per share. You can't do that. You can't. Dilution or giving power to certain shareholders cannot be done when you've done default with regard to payment of preference share dividend. Have a look. Yeah. As per the information available, company has defaulted in payment of preference dividend for 3 previous years. So company cannot issue shares with differential rights in spite of fulfilling other conditions. Got it? That's 6B2. Are we now ready to go to 6C? Chalo, we have here question number 6C. What are the disclosure requirements as per for operating lease as per AS 29? So this is something that I was also not completely familiar with, for a reason that I have not taught accounting standards for almost like last 1.5 year now. Yeah, 1.5 year I haven't taught this topic. So, and even if not also, I wouldn't be able to tell all five. I would can just tell like, okay, there were 5 disclosure requirements or 6 disclosure requirements. I could have come somewhere close there. So this you can say a kind of very unexpected kind of a question what I think not majority of the students might have attempted, but no disgrace. Like if you definitely if you have attempted this kind of a question in the examination, trust me, you've done a splendid job. And one round of applause to all of those people who would have actually prepared for this sort of a question also and answered it in the examination. Great guys. And disclosure requirements. Actually, I didn't. What to say? Know all of it. I typed it by looking into the grid text. This is the only one that way. Rest of it I've done it myself. This is the only one what I had to look into the grid text to type in the answer. So I put in here. So the disclosure requirements are like this. Minimum lease payments. Yeah, non-cancelable thing for the periods up to 12 months. How much is it? 12 to 60 months. How much is it? And more than 60 months. How much is it? We should tell. And then future minimum sublease payments expected to be received under non-cancelable subleases on balance sheet date. That has to be disclosed. Lease payment recognized in the profit and loss account for the period. Yeah, with separate amounts for minimum lease payments and contingencies has to be disclosed. And couple of other things are also there. It's better that you read it by yourself rather than me reading it out now for the sake of reading. Yeah, that's with regard to 6C. But not a kind of very torturing kind of a question, because you need to remember that question number 6 has 5 sub questions and you need to answer only 4. So I think majority of them would have definitely skipped this one only. Yeah. Let's see 6D. 6D, this one is with regard to liquidation. The trick here was like there are multiple types of shares. So when you have to repay, some shareholders say you collect money, some shareholders you pay money. So shares are of different nominal value and different denomination. So how do you arrive at that equated number of shares to identify the amount repayable to each share, and then how do you convert it to the actual number of shares that we have and all of that? A very interesting question. So chalo, let's read this. The position of Bad Luck Limited on its liquidation on 31st of March 2022 is as under. Yeah, there is preference share capital, equity shares, 3 variants. Yeah, and there is calls in arrears. And this is 100 rupees share, this is 50 rupees share, 10 rupees share. 100 rupees share is fully paid up, 50 rupees share is 10 rupees uncalled and unpaid, and 6 rupees for 10,000 equity shares is uncalled unpaid. Calls in arrears are 3 lakh and calls received in advance are 2 lakh 55. Preference dividend is in arrear for 2 years. Aye. Yeah, amount left with liquidator after paying, after discharging all liabilities is 1 crore 25 lakh 15,000. AOA provides for preference dividend in priority in return to equity. That's quite obvious. You are required to prepare liquidator's final statement of account. It is like a receipts and payment account. On the receipt side, opening balance will be 1 crore 25 lakh 15,000. You will first adjust for calls in advances and calls in arrears. Then you would repay the premium, you pay you pay dividend to preference shareholders, then you repay preference shareholders, then the balance has to be adjusted among equity shareholders. Chalo, let's see this. Like I mentioned in the books of Bad Luck Limited, liquidator's final statement of account. Cash opening balance 1 crore 25 lakh 15,000. This is after repaying all the liabilities. Then there is calls in arrears to the extent of 3 lakh, calls in advance to the extent of 2 lakh 55. I'll write calls in arrears 3 lakh. Got it? And calls in advance, you will repay 2 lakh 55, and calls in arrears you collect. Now, you first repay the preference shareholders. Preference shareholders, you would have to pay 90,000 multiplied by 100. Preference shareholders, 90,000 multiplied by 100 is their preference share capital. And you need to pay 90,000 multiplied by 100 into 10%, that preference share rate, for 2 years because it is outstanding, which again comes to 18 lakh. So 90 lakh plus 18 lakh, total 1 crore 8 lakh has to be repaid to preference shareholders. Out of this 1 crore 25 lakh plus 3 lakh, we repay this, then we repay calls in advances. So then what is remaining? So both of these are done by working note. This and this you won't get to know straight away. You have to do a working note to understand this. Yeah, let's understand how does it work. Amount available is 1 crore 25 lakh 15,000. You repay, you collect calls in arrears 3 lakh. You repay 1 crore 8 lakh. That is preference share capital plus premium to our shareholders, preference shareholders. Then calls in advance will be repaid. Money left with you to pay equity shareholders is 17 lakh 60,000. Now, we need to do notional calls. What is notional calls? Here, these shares are fine. These shares are fine, fully paid up. Now, concentrate on the next two shares. This 30,000 shares of rupees 50 each are 40 rupees paid up. 10,000 equity shares are rupees 10 are 6 rupees, 4 rupees paid up. 6 rupees not paid. So, on 30,000 shares, we assume to be receiving 60 rupees. And on equity shares of rupees 10, we assume to receive 6 rupees. So I do that 30,000 into 10, 10,000 into 6, notional call. I'll add this money so that the shares will become fully paid up. Now we have 21 lakh 20,000, assuming this notional call. And this has to be repaid to three different variants of shareholders. So what I'll do is I'll convert this. So this 30,000 shares of rupees 50 each, if I equate it to my 100 rupees shares, can I say it becomes 15,000 shares of rupees 100 each? Because 2 shares of rupees 50 is equal to 1 share of rupees 100. So 30,000 equity shares will become 15,000 if the value of 50 becomes 100. Similarly, if I want to convert this 10,000 equity shares to this equivalent, it will become into 10, no? So here you should do divided by 10. So 10,000 equity shares of rupees 10 each is equivalent to 1,000 equity shares of rupees 100 each. You get this? So equated number of shares is what will arrive. Of 100, 50 and 10, we have 90,000, 30,000, 10,000. So this 90 if we keep constant, this 30,000 shares will become 15, 10,000 shares will become 11,000. Got it? Yes. In this context, equated number of shares is 90 plus 15 plus 1. That is 1 lakh 6,000. That's 1 lakh 6,000. I hope you guys got it. If we find the EPS, it is 21 lakh 20,000 divided by 1 lakh 6,000, which comes to 20 rupees. This is not the final answer. This 20 rupees will hold good only for these people. Here you have divided, no? So now this 20, so here you increase the number of share, no? So that 50 rupees shareholder and 10 rupees shareholder will not receive 20. 50 rupees shareholder will receive half of 20. That is 10 rupees. And 10 rupees shareholder will receive 1/10 of it. That is 2 rupees. Yeah. So 1000 rupees, 100 rupees shareholder, no? Refund of 20 he will get. That is the money that he will get. 20 shares in 20 rupees per share into how many shares are there? 90,000 shares. 18 lakh. 3 lakhs. No problem. But shares of rupees 50 each, no? They pay notional call of rupees 10. They get refund of 10. So basically they don't have to pay anything, they don't have to receive anything. So from these shareholders of rupees 50 each, there is no collection, no payment. And lastly, coming to the shares of rupees 10 each, against them we collect 6 rupees, we give them 10% of the 20 rupees, 1/10 of that 20 rupees, that is 2 rupees. So you need to refund them to collect 6. Net is 4 rupees notional call. So we make a notional call of 4 rupees from them. 4 rupees into 10,000 shares, that is 40,000 rupees. That's it, guys. That's the answer to question 6B. Frankly speaking, by this we are done with 120 marks. We'll do one last question for 125th mark. A very easy, teeny tiny, small one. This question is from Employee Stock Option Plan, ESOP. Have a look. On 1st of April 2021, a company offered 100 shares to its employees, to its 5,000 employees at rupees 50 per share. Okay. The employees are given a year to accept the offer. 1 year is the time given, vesting period. So you don't have to split the expense over several years. Entire employee compensation expense you'll write in 1 year. Easy, isn't it? Okay. The shares are issued under the plan subject to lock-in and transfer for 3 years from the grant date. Okay. The market price of the shares is 60. Due to post-vesting conditions, the fair value is considered to be 56 and the fair value per option is worked out to be 6. Because there are conditions of 3 years you should hold. Because of that, they're saying though the value is 60, they're bringing it down to 56 as fair value. No problem. Then 4,000 employees accepted this offer and paid 50 per share and purchased the share. Nominal value is 10. Very simple. Whenever the money is collected, bank account debit to the extent money is received. Employee stock compensation account debit to the extent it is intrinsic value of the option. Company is giving the benefit. Credit में equity share capital account first one, that is nominal value. To security premium, that is for the difference between issue price and the nominal value. In this context, the money that we're collecting from the employees is 50 and the intrinsic value is 6 rupees because the fair value is 56. The share of 56 rupees is being issued by collecting only 50 rupees. 50 rupees per share you are collecting money. 6 rupees is your expense. nominal value is 10 rupees, 56 minus 10, 46 rupees is security premium. Yeah, this is happening for 4,000 employees, and each employee is getting how many shares? 100 shares per employee. So we will be doing bank account debit 4,000 employees into 100 shares into 50 rupees collected. And for employee compensation account, 4,000 employees into 100 per share into 56 minus 50, that is interest equal to 6 rupees. And for our equity share capital account, it is 4,000 employees into 100 shares per employee multiplied by 10, and security premium is 46 per share into 4,000 employees into 100 per share. That's it. We're done with this entry. And we should not forget to transfer this employee compensation expense to P&L, for which the entry is P&L account debit to employee compensation expense 24 lakh each. If this vesting period was longer than a year, then this 24 lakh would have been split over several periods, 2 years or 3 years over the vesting period. And however, there is again something else that will newly come in, that certain options got cancelled at the end of there and all. So for this information, this is the answer. Overall, if you ask me, I'll say pretty much a very easy paper, considering the fact that there was an easy question from segment reporting. Voting rights was such an easy question. Partnership could have been very complicated. Partnership may also, it was very easy. Consolidation with not many adjustment. Amalgamation was also very tolerable one. Yes, it took a little time for consolidation, but easy to do one. Leases question was little hatke, but otherwise, as I see, a liquidation little lengthy, little tricky, you can say. Not many students would have been very comfortable doing that net refund computation or notional call computation. That I don't think not many people are comfortable, especially three variants of shares coming in. So otherwise, overall, you can say, in my opinion, is a very much solvable paper, and a student with bare minimum preparation can do really well in the examination. So wishing you all of you who have written the examination and watching this video a very good luck in your results, and hoping to see you all clear your CA intermediate, getting into articleship and preparing for finals. And those of you who are writing the next coming examination, watching these sessions for your knowledge purpose, trust me guys, you might have been feeling very confident after this session, and you will feel lot better after you write your examination. And for the attempt in which you write also, I'll be doing this kind of a session which comprises of all the answer discussion. If there is any session that you would like, would want me to take up or do, please do let me know in the comment. And if you did really like this session, you can like, share, subscribe, and comment on this video. And please do share it with all your dear and near ones. Tell them that this is something that you saw and it was something nice. That's it. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you guys either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So the thumb rule to stay happy is pretty simple. It is to stay in the game. So one last time on this day, I have just one simple question to all of you guys. Are we in the game? I hope the answer is yes, we are in the game. You can let me know about that in the comments. Tata, bye bye. See you all guys in the next video. Till then, have a great time.